Rotarians and guests, welcome to the February 10th meeting of the Rotary Club of York. Our members are dedicated to service above self and Rotary's four-way test. Leading our opening song and pledge today is President-elect nominee Glenn Miller, and providing our invocation is past District Governor Patty Rooney. Glenn. Glenn, you're on mute. You definitely don't want me leading the songs. There we go.
Sorry about that. Please join me as you are inclined. God bless America, land that I love. Stand beside her and guide her through the night with the light from above. From the mountains to the prairies, to the oceans white with foam. God bless America, my home, sweet home. God bless America, my home, sweet home. I pledge allegiance to the flag of the United States of America and to the republic for which it stands, one nation under God, indivisible, with liberty and justice for all.
Would you join me in a word of prayer? Gracious and Almighty God, we give you thanks for the privilege of being able to serve in this body called Rotary. You have called us from far and wide to serve others above ourselves. You have called us and challenged us to find the means to assist others in their needs. We give you thanks for the opportunity to continue that service in many and various ways. We give thanks for all the good that we have been permitted to do in this club and our community. We look forward with confidence to continuing that service into your future. Yet even as we gather with thanksgiving for all that we have been given, we remember those whom it would be easy to forget, the poor, the needy, the hungry, and the homeless. We pray that out of the abundance you have given us, that we might remember those who are in such need and open our hearts in generosity, kindness, and love, so that they might share in the goodness offered to us all. Bless our speaker as she shares with us information on the economic outlook and the future growth and development of our nation and our communities. We give you thanks for this day, for the fellowship we share, and ask that you would bless our club, our district, and all Rotarians throughout the world as they seek to serve others above themselves. And may all that we do this day be done to the glory of your most holy name. Amen.
Amen. Thank you to our Dos Padres, Glenn and Patty, for lending your expertise to open our meeting today. Now for the announcements. Thanks to more than 1/3 of you who responded to our DEI committee survey. This is your last chance for the entire membership to share your feedback that will fuel the direction of our DEI committee and our club's work. This survey was emailed to all members on January 28th at 7:15 a.m. If you did not receive it, first check your junk folder, and then if it is not there, contact Chris Toff. The deadline to participate is this Sunday, Valentine's Day. Can't think of a better thing to do than celebrate Valentine's Day with submitting your survey questions. Our club board of directors will meet tomorrow at 8 a.m. Rotary International has unveiled our new 2021-22 presidential theme, Serve to Change Lives. Incoming Rotarian International President Shekhar Mehta urged members to become more involved in service projects, as caring for and serving others is the best way to live, because it changes not only other people's lives, but also our own. As Patty said, the privilege of service. Mehta is a member of the Calcutta Rotary Club in West Bengal, India. He revealed next year's presidential theme, Serve to Change Lives, to incoming district governors on February 1st during the Rotary International Assembly. And as you can see, here is the accompanying logo for next year's theme, Serve to Change Lives. And it reminded me, it's a timely, with Valentine's Day coming up this Sunday and the unveiling of Rotary International theme for President-elect Jackie Summers' year, that we look back in time to 2002 when the first Summers became our club president. Mike Summers was club president in 2002, and the Rotary International theme that year was quite memorable. It was Sow the Seeds of Love. I just pictured Mike as like a Johnny Appleseed of Rotary Seeds of Love. Someone at Rotary International was a Tears for Fears fan. Well, President-elect Jackie, you fared much better with the Rotary International theme for your year and our year, Serve to Change Lives. Okay, on to the business spotlight. The Andersons are a rare breed and proud combination of third-generation family business owners and third-generation Rotary Club of York members. Rotarian Jim Anderson Jr. joined our club in 2004, and Jim Anderson III joined 4 years after his father. Jim Jr. founded Coupling Corporation of America with his late father, J. Hilbert Anderson Sr., otherwise known as Andy. Andy was a Rotary Club member for more than 31 years. Jim Jr. and Jim III own and manage Coupling Corporation, as well as several other companies, including C Solar Power, J. Hilbert Anderson Incorporated, Tritech, and DRI Machine and Fab. You'll likely find it interesting that the products from a York County family-owned business have customers, including ExxonMobil, Sun, Chevron, Saudi Aramco, Shell, BP, the US Navy, the US Army, and NASA. Coupling Corporation has manufactured high-performance flexible shaft and rigid coupling and keyless hubs since 1968. Their products are designed for rotating machinery, high-speed equipment, and other demanding applications. The Anderson keyless clamp hub simplifies shaft mounting applications with designs that do not require heat and hydraulics. CCA operated through the pandemic as an essential industry. Some employees have contracted COVID with varying degrees of severity. Some staff are working remotely while most are working on site with mask wearing and distancing in place. Their DRI machine shop in Hanover has been making parts that are integral in COVID-19 test and treatment equipment, thanks to Jim Jr. and Jim III. Now for an announcement from our Student Education Committee regarding scholarships. Diane.
Thanks, President Ann. Hi, everybody. The scholarship season is upon us once again. It comes along very quickly, and I'd like to thank the Student Education Committee and special thanks to Renee for once again managing all of this. Just a quick announcement to let you know that our merit scholarships, the Arlington Cayley Rising Musician Scholarship and the John and Paige Smith Agricultural Scholarship are now available to apply for. All of the information has been sent to the York County Schools and is also available on our website. So please, I'd like to make the announcement that if anybody online here today knows of a student, please reach out to them, let them know to go onto our website or contact Renee at the office and she will get the necessary information. The rest of the scholarships will be available in the next few months, but for now we are focusing on the 2021 graduates. Thanks, everybody. Have a good day.
Thanks a lot, Diane. Appreciate your work and that of your committee. I saw Courtney Bailey was on our networking prior to the program beginning. Courtney, will you please add this to our Facebook page? That would be a great way to get this information out to the community. Thanks, Diane. Thanks, Courtney. Okay, up next is our program, and I would like to ask Rotary Club of York East member Steve Altland to introduce Linda.
Good afternoon, everybody. Can you hear me?
We can hear you, Steve.
Okay, great. As Ann indicated, my name's Steve Altland, and I oversee the Wealth Management Division at People's Bank, and I'm also a fellow Rotarian as a member of the York East Club. And it's my distinct pleasure to introduce our speaker today. Our company works closely with Federated Hermes, the firm from which our speaker represents. Because of that, I've had the privilege and the opportunity to hear our speaker, Linda Duessel, on numerous occasions over the years, and it's always an informative and very engaging presentation. As senior equity strategist, Linda is part of a team responsible for formulating Federated's views about various equity market conditions and the firm's positioning strategies. Linda has been a regular on CNBC's Closing Bell, as well as Fox News' Your World with Neil Cavuto and Bloomberg Television. Linda earned her master's degree from Carnegie Mellon University and holds a bachelor's degree from the Wharton School of the University of Pennsylvania. Linda is a CFA charter holder, a CPA, and a CFP professional. Thank you all for joining us today, and I'd like to turn it now over to Linda Duessel.
Hello, everyone. Can you see my screen?
Not yet, Linda.
Oh, not yet.
Yep, you should be able to go ahead and do that now. There you go, we see you.
Well, I'd like to thank you very much, Steve, for your kind introduction, and Ann and everybody from the group here for the chance to talk with you today and to share with you my company, Federated Hermes, outlook on the economy and the markets. As the title of my presentation suggests, it all depends on your horizon. In the interest of your time, I may pass one or a few of my slides, but definitely make sure that I give you the thrust of my presentation today. Before I dive in, I'd like to take notice that the market, the S&P 500, kind of flat on the day, in and around S&P 3908. This is right at really an all-time record high in the stock market. We at Federated Hermes are bullish on the stock market for this year. We have a 4,500 target for the S&P 500, which I think is maybe another 15% upside this year. And with the sort of growth that we're having right now and coming out of the economic slow patch and the easy money basically that is out there, I've been saying really since about a year ago, maybe about 11 months ago, it's very dangerous to be a bear with this in mind. Beyond the chance to talk to groups like yours, I write a weekly piece on my website. Last week it was entitled As Plentiful as Face Masks, where I discuss the main concern that is affecting the market today in general market participants. And it's a poor sentiment on COVID. People that are worried about whether or not the vaccine will work, particularly on mutations and the ability to actually get that vaccine. And I think there's a lot of really good information that maybe a lot of people don't know about this. And to the extent that the market is not pricing this in, when we all come to realize that we really do have a handle on this and the vaccines are going to be as plentiful as face masks before very long at all, I think that that'll give us another good push to the stock market. You know, people are worried about the efficacy of the vaccine. There were 5 vaccines out there now. In all cases, anyone who took those trial vaccines, there were 0 hospitalizations and 0 deaths. There have been mutations, as you may know, in the United Kingdom, particularly and in South Africa. The efficacy is only maybe 63% for one of the major drugs there with that mutation, but 0 people have gone to the hospital who have had the shot. So therefore, it looks like we'll have herd immunity by June, and the summer looks really, really good. So we are bullish. And you know, we have been bullish for some time. And people have talked to me. I've done a lot of meetings like this, and I'm so thankful for the chance to be able to speak with you, even if it has to be this way and we can't be in person. we've been able, many of us have been able to really not miss a beat throughout this. And a lot of companies in our country have done very, very well. Lots of people have asked me, you know, if you're someone who watches the major news programs, maybe the financial programs, they'll go on a commercial break and they'll show you maybe a picture of Times Square, one of the bigger cities. And you look at that picture and you see unusually small amounts of people walking the streets, unusual amount of traffic out there. And you think, this is not healthy. This is really kind of spooky. And then you look over at the market and it's making new highs. And people have asked me, did that make any sense versus the fundamentals? So we remember that the stock market is itself looking forward. It's not about what we know today. The stock market is about looking forward and what the market participants believe that the earnings of corporate America will look like in the next 6 to 8 months. Last year, in perhaps a once in a 100-year type of an event, we in the United States, it's a pandemic all around the world, we forcefully shut down our economies, basically throwing ourselves into an economic depression. It was the deepest since the Depression, but it was also the quickest recovery since then. And after that second quarter, things look really, really good. Why did the market come back so strong? Well, it makes a lot of sense if you realize, as my first chart to you shows, that fully 75% of the major hit to earnings was attributable directly to the pandemic. Energy, other travel-related, airlines, we all know what got hit very, very hard. But a lot of the economy has continued to do very, very well. And yes, corporate profit margins got hit really hard. That's what this chart shows. It goes all the way back to the 1950s, the bars representing recessions in our country's history. Though the recent one didn't get booked yet because they haven't determined exactly the start and end date of it. And what you can see here is that corporate profit margins in the United States reached an all-time record high at the end of 2019. Terrific margin enhancement through the end of 2019, and then we shut down our economy. Profit margins got hit hard here. But you know, as hard as they got hit, and they've clearly turned around, starting the third quarter of last year and moving into the fourth quarter in our earnings results, we could see that. As badly as those corporate profit margins got hit, they were higher than at the peak of any prior business cycle. I just think that's very, very powerful, and it goes to how very, very strong is corporate America. And that's great news as we look as stock market investors. We love that, but it's not just that. Here we look around the whole wide world. This is a chart that I get updated monthly, and it shows many of the major regions of the world and how are particularly their manufacturing economies doing. Even if we're a service-oriented economy, manufacturing economies are with all around the country are worth looking at, because they are the most sensitive to changes in economic prospects. And what we find here is a figure which we get every month. And this chart is putting here for each of the various areas. This is the United States manufacturing right here, is looking at what was the figure for this month. And was it above or below this 50 line of demarcation that shows whether your economy is in expansion or contraction mode? Indeed, for quite a number of months now, after that terrible recession the whole wide world fell into, the vast majority of countries are up above that line, with the exception of Mexico here in my listing. Here's China, the second largest economy in the world. And yes, they are weakening month over month. We want them to be strengthening, and that's what this chart shows, that from the month of November into December, you actually saw an improvement. That is great. We want as many countries as we can in this top right quadrant. That is an indication of a global synchronous economic recovery. And of course, there are a lot of people around the world complaining about the availability of vaccines, the supply of them, getting them actually to the people. We at Federated Hermes believe that you will see, my boss likes to joke about July 4th. July 4th has fireworks, the kind of global fireworks that will occur when we see the whole wide world opening up. And then we'll watch out for a pent-up demand, and then we'll talk about what we can worry about with that, because we in our business, we always have to worry about something, don't we? So now let's look at corporate earnings. As a stock market investor, that's what I'm concerned about. And I'm a student of history as well. What I want to know is how fast can corporate earnings, which got hit hard, recover from their peak? So we look at historical cycles from earnings peak to its trough. How many months did it take? And then from the trough in earnings to get back to the recovery, to get back to the level at the previous high in earnings, how long did that take? Of course, history doesn't match exactly, they say, but it does rhyme. And history tends to show, as my chart on the right here shows, that however many months it took for earnings to get from peak to trough is pretty closely related to how many months it took to get back. So if we look at the global financial crisis, remember when the housing bubble burst back in 2007 and 2008, took 23 months to get from peak to trough earnings and about 27 months, not exactly 1-to-1, but reasonably close. As quickly as earnings declined this time around, wow, we could really get that back and quick. And that's what Wall Street analysts are considering. I really love this chart for several reasons. Here it goes back to 1971, and it looks at the earnings of corporate America. You know, in my job, before we got to work from home, I used to travel all around the country talking to groups like yours. I've been in all 50 states in the land in the last, say, 13, 14 years. And I can't tell you how many times I have said, we at Federated Hermes are bullish, and people would say, how can you be bullish when stocks are at all-time record highs? Stocks are a reflection of corporate America. And look at how the earnings of corporate America have grown over the decades. As I said, in 2019, we had record high corporate profit margins and corporate earnings. That justifies a record high level of the stock market. And then we got hit hard with the pandemic. But because analysts on Wall Street know that the vast majority of the hit to earnings were directly related to the pandemic, and if you believe, as I have said now for almost a year, it's temporary. We're going to get through this. We're going to get back to normal. And many people have been surprised as to how many industries got back to normal and really haven't missed a beat. And of course, we know some of the bigger companies out there, Amazon, a great example, just having an acceleration in their business because of the work from home and just basically fixing our homes and buying new homes. Is a housing boom, if you will. That Wall Street analysts have suggested we can get back to those old earning highs by the end of this year. But I tell you, if the third quarter earnings announcements of last year and the fourth quarter earnings announcements, which are almost done for this last quarter, are any indication, this number will be exceeded. If this was 167, we at Federated Hermes think we could get to $180 S&P earnings by the end of this year. And that's how we've come up with the $4,500 level for the S&P target. You're somebody who believes that the United States dollar, which has been extremely strong really since 2015, is set to decline here. That would supercharge this earnings rebound. You know, we don't want a crashing dollar and we don't want a dollar that's too strong, but a dollar that's going from very high levels to a slowing dollar, like a slowly declining dollar, is actually a great tailwind for earnings. And the reason for that is because half of the revenues of the S&P 500 companies are actually to customers outside the US. And if our dollar looks too strong, well, guess what? It'll be too expensive for those outside the US, and we won't be as competitive as other countries out there in terms of other companies out there in terms of their products. This is what this historical chart shows, goes back to the mid 1990s, and it shows on an inverted basis, if the dollar is weakening, this is a weakening dollar of late. Coming down here is a rising dollar. A rising dollar can be a headwind to corporate earnings because you can't export a lot of your goods and services like the big companies would like to. And a weakening dollar can actually help earnings. You can see kind of how they kind of dovetail together over the years, where here we are, where the value of the US dollar has come down about 10%. here in the last 12 months or so. And the earnings growth forward, the expectation for the next 12 months earnings growth has come down. These lines are going to have to converge somehow. And we believe that you're likely to see the increase in the expectations for corporate earnings. And that's bullish. I'd like to now turn to a couple of charts on COVID itself and its effect on the economy and on the earnings of corporate America. And what we're showing you here is what we as Americans spend our consumer wallet on. The United States is a consumer-led economy. Our wallet is about $17 trillion a year. That's what all these figures show you. Housing is the big one. Housing, transportation, food, these are the big ones. Personal insurance and pensions, and this is how it adds up according to the Bureau of Labor Statistics. In the pink here, we're highlighting those social distancing industries that were shut down and are still suffering. We all know what they are. Hotels, airlines, restaurants, sports and concerts. Oh my gosh, we're so anxious to get back to a live sporting event, aren't we? It's so strange to see those cardboard people in the stands. You know, go back to see a concert, movies. We want to get back to that, and it just doesn't seem that our economy can be so strong. But you know, of the entire consumer wallet, only 4% is represented by these pink areas, just 4% of the consumer wallet. And unfortunately for restaurants and eating out, fully 63% of that figure are those are the industries that really, really got hurt. We look at the social distancing sectors. And this shows you, though, unfortunately, that those people who lost their jobs, these are the 20 sector industries with the largest job hits. Unfortunately, we're in the lower income cohort, where the average pay is $35,000 a year. Now, that's not as big a piece here that's highlighted in the red part of the bars here of personal income, and that's thanks to transfer payments. That's thanks to monies from our government, subsidies to help people to make their way through. But you can see in terms of wages and salary, again, it's the same groups out there that got hit hard. We're looking here at the remaining employment gap. These are of about half of the jobs that were lost have been recovered. And what this shows you is how many jobs recovered in the hashed part of these bars versus the remaining jobs since January of last year. The highest risk areas still have about 6 million jobs we lost. This is the sort of, I just find this interesting, the sort of areas that still need to get their jobs back recovering. Look at those poor restaurants and bars. The Congressional Budget Office has suggested that it'll probably be 2024 before we get back to pre-pandemic levels in terms of the employment gap. That is a problem, and that has longer term implications. Here's a chart that I really want to focus on, because this goes to the moral hazard, if you will, of all this free money. Lots of people also have asked me, how could this be? How could we get so many individuals and households got those $1,200 checks? They're talking about more checks coming their way, the extra money, I think it was $600 for those unemployed, and then extra monies from December that was announced. How can this be? How can we print money from out of nowhere? And indeed, we have printed money from out of nowhere. We are today throwing trillion-dollar figures around as was never before heard of, in a manner that we would have thought that were totally unheard of just a year ago. And why doesn't this bring hyperinflation? I've had the hyperinflation question numerous times. Why aren't we getting hyperinflation? It's definitely unprecedented, and unprecedented makes us nervous. It's breathtaking, yes. So between the amounts of money that our central banks have given us, have injected into the system, the 0% interest rates, the the liquidity by buying individual securities out there, plus the fiscal stimulus. Those are the individual checks directly from the administration to individuals, and the payroll protection program for the small businesses in the United States together. Now, this is through December, represented about $10 trillion, which is an unbelievable amount of money, a breathtaking amount of money, but our country is large, so it represents just under a half the size of our economy. And of course, it's okay. It's not hurt the value of the US dollar, not much. It's not given us inflation, not much. Why? Partly because we're still shut down in areas, but importantly because the rest of the world's doing the same thing. Because it was a pandemic, they're doing the same thing. It is only Japan, which is a much smaller country, that promised a bigger share of the size of their economy in stimulus. Now, if you want to worry about something, I think it's worth worrying about the fact that even though our economy has come back very, very nicely, and I may still show you a chart or two on that, and the global economy has too, that whole synchronous global recovery. The United States, the Biden administration continues pushing through now through budget reconciliation, and with a Democratic sweep, chances are they'll get the lion's share of another $1.9 trillion in terms of a stimulus. That 1.9 on top of the 0.9 promised in December is another $2.8 trillion on top of this level. That's another 13% of GDP represented, which would make us outsized versus the rest of the world. This is where the rest of the world might start taking notice. This is where the value of the US dollar may take a hit, and we may see that in the dollar getting hit. We may see that in price to earnings multiples on stocks, inflationary expectations, and that is something we can concern ourselves with if we're the only country doing extra large sized stimulus. Is all the monetary stimulus that was done a moral hazard? This looks at the biggest increases in the balance sheet of the Federal Reserve in history. And well, what is it? 1, 2, 3, 4 of them are directly associated with COVID. And the next one is likely to be adding to this list. This is a potential moral hazard. Is there a fiscal stimulus moral hazard? Money going directly to corporations. This goes back to 1960. What percentage of cash versus total assets? It has skyrocketed to all-time record highs. What about for the consumer? Is there a moral hazard giving the consumer lots of money? This looks at the free cash flow as a share of all personal income, goes back to the 1950s of the United States consumer. It's skyrocketed. Now it's come down a bit from the big checks that came through, partly because we've started to feel more comfortable. We're getting some confidence back, and they're opening more places, honestly. And this can be drawn down, but much of it has been saved. In fact, we have research that shows much of it has been put into the stock market and helping to give us new record highs in the market. So who's the champion of debt? The government debt as of 2020, the rise during the year, and our population. United States of America is the winner in terms of government debt per capita, now almost $68,000. Only Japan again is higher, but look at how that number increased just in 2020. And we're looking to increase that number. That is a hazard, that is a risk, and definitely could give us a problem in the longer term, if you're looking at the longer term. But in terms of debt service, well, that's what it's all about. It isn't about paying our debts, it's about paying interest on the debt. This is a really interesting chart. I'm sorry it's so busy. It goes back to the 1940s. The Nonpartisan Congressional Budget Office was figuring in the dotted lines here before COVID ever hit. Just because of the fact of the growing Medicare, Medicaid, and Social Security, that's all us baby boomers, our huge generation, retiring, 10,000 of us per day, living many, many, many years in retirement and collecting these payments. Congressional Budget Office figured by 2030, the debt of the United States, the federal debt as a share of the size of our economy, would be an all-time record high 111%. With COVID and all that borrowing, they figure, well, unfortunately, 119%. Breathtaking in its own way. But what about paying the interest on that debt? This is really kind of interesting because before COVID hit, they figured by about 2030, we'll have to spend 2% of our GDP just on interest expense. Then COVID hit, then we borrowed tons and tons of money, trillions of dollars, and actually they expect the debt service to be less. Is that a typo? No, it is not. It is simply a reflection of the idea that in the United States and around the world, you're seeing generational low interest rates, which can stay lower for longer. And I will tell you, as somebody who's been traveling really since the bull market began from the last crisis in 2009, and people just suggesting we're going to have an inflation problem. The economy is growing. We're going to have an inflation problem. All this easy money, which we started back in that crisis. And I'd say, you explain to me how we're going to get an inflationary problem. Haven't done so yet, but we're fixing to. In terms of the short-term interest rates, our Federal Reserve has said we're not thinking about raising interest rates anytime soon. That is music to the ears of any stock market investor. We love that. And you know, those who worry about inflation, their target inflation is 2%, not only in the United States, but also around the world. 2% has been very hard to get to. It's been under that level for quite some time. We have been in and around 2% in the United States for decades. And when you look at the unemployment rate and when historical Fed chairs first started raising rates, the last figure we saw was very excellent decline in the unemployment rate to all the way down to 6.3% in January of this year. It kind of puts it in the realm, but we also have to remember that the participation rate, we have a lot of people that just dropped out of the job market. And to the extent they come back to the job market and we get back to more normal levels, that should lift the unemployment rate. That's a healthy advance in an economic recovery. But we take the Fed at their word, particularly not for this year, probably not for next year, not raising rates. Again, music to the ears of a stock market investor. And interest rates are low. Should we worry about rising yields? You know, you didn't need to since 1945, and these movements they take long, long periods of time. Interest rates rising and then declining. We really had a hard time back in the 80s. I remember thinking that interest rate could fall. If only we knew they could fall this much. Here we are now. See that little hook down there? Is that the beginning of something? Maybe, and quite potentially, if we don't watch the value of the United States dollar. But at least we don't have negative yields. This chart shows that around the world, if you give your money to, this is for $18 trillion around the world, you give $1 to a government for 10 years, they'll give you less than $1 back on maturity. Who would do that? But there's $18 trillion priced that way. What does all this debt growing do though? We can service the debt because interest rates are at an historically low figure here in the US and around the world. But historically, whenever you had debt versus the size of the economy, as my circle down here at the bottom shows, above 105%, and we are certainly there now in terms of this calculation, this particular one with the federal government debt, that slows down economic growth for the longer term. You know, somebody has to pay for this. And if interest expense keeps getting paid out of the federal coffers instead of putting it out into the economy for the growth of it, that's going to slow down our growth long term. That's something to worry about. In the meantime, the biggest durable anybody can buy, a house, housing is booming. It's absolutely booming. And that looks to continue. It looks at here, we look at the housing affordability. Can I afford to buy a house based on an historical calculation with debt service considered? And what this says is, if I go back to the 1990s, If the housing affordability is extremely strong now, if rates raise up by 50 basis points or even 1%, still quite affordable because rates are so very, very low now. And that's good news for the earnings of that sector and for the market, of course. Should we worry about rising inflation? This is the Federal Reserve's underlying inflation gauge. From what I see here so far, there's no evidence of any worry yet. And we are not worried about this yet. People worry about that pent up demand being released. Fireworks on July 4th. Yes, we're all going to race out and I'm told if you expect to have a vacation sometime in the back half of this year, you better well have major reservations by now and secured your airline ticket. But is that really going to give us the inflation? This looks at the areas of pent up demand and look at what they are. Again, the restaurants here, personal care, live events. This is too small, in my personal view, too small a portion of our economy for the sort of too many dollars chasing too few goods to have a problem and to result in a big inflationary problem. That's too small a piece of our consumer wallet. And so I don't believe it. You know, we've had a housing boom and it's really not reflected in the inflation levels yet. My personal worry, as I suggested, is about the value of the US dollar. And I'll tell you, businesses are not worried about inflation. Businesses are worried about increasing regulations now and the uncertainty that comes with the change in regulations, but possibly every 4 years. It all depends on your time horizon. My time does not allow me to get into individual sectors, but in a growing and economic economy, that's what we are in now. Our central bank has our back. So does our leadership in DC. An unbelievable stimulus that argues for those cyclical growth areas, which we're starting to really see get some love out there in terms of the advancements in the stock market. Excess money is now chasing financial assets. And this looks historically in the red at what loose money did historically and the growth of our economy here in the blue line. You saw loose money raising interest rates big time there. That was back in the 70s and the 80s. That was the inflationary problem that whose back was broken, and tighter money drove down inflation, the so-called Great Moderation. Now you've had a series of loose money out there. It hasn't given us general inflation, but it sure has inflated asset bubbles. It always makes its way into financial assets, does easy money. Risk on, this chart says. We're looking here at Robinhood accounts. Robinhood accounts, that's the millennials version of Schwab, if you will. And look at the number of users holding the S&P 500 ETF, the most popular of them all, dovetails very, very nicely with the increase in the money supply. That is the easy money going out to help us through the tough times, and many of it went right into the stock market. This shows you that the correlation between factors, I don't have really time to get into this in depth, but what we have seen is a high correlation in terms of the momentum factor in particular. Didn't matter whether the stock was large, small, what sector it is, what industry, what country. If it was a momentum stock, it was bid up or down together. An all-time record high in terms of factor correlation is the hallmark of machine-based trading. I think we need to appreciate that today. Over 90% of all trades in the market are done by a machine which has been programmed. What does that mean? That tends to mean that the market or particular areas of the market can go up quickly and then down quickly. So we need to prepare our tummies for volatility. Does not mean that the end of it all, valuations in stocks don't settle to their fundamental values. If you've been watching the GameStop saga, those who bought at the higher, figuring that out. Lots of people last year's advance was really based on those big FANG stocks. We all know those names, they're listed here, the big 5 stocks. And people thought that was so narrow and so spooky. And it is spooky to have a narrow market where only a handful of stocks are participating. But what we show you here is that if I looked at the actual share of the earnings of the entire S&P 500, these companies are so superbly profitable, that their earnings per share are commensurate with their market cap per share. It's a fair price, tiny exception of Amazon. I don't talk individual stocks, but I would argue that Amazon they'll make as much money as they want once they're done gobbling up industries' market shares as they look around. And of course, there are 495 other stocks still on sale. Even if the rest of the stock market has done well, and I'm so happy to say that the broadening of the stock market has been a great thing. That is a source of strength when the rest of the market joins in. But still, we as fundamental analysts at Federated Hermes, we can find a lot of other good names underneath the surface of the marketplace, and that is a strong market. Risk on. How will I know when this is done? Watch particularly those travel related stocks. If you're someone who's interested in watching the market, watch the airline industry, watch the hotel industry to where their stocks get back to what they were pre-pandemic. And that might give us a feel that the best is potentially behind us in this wonderful bull run. But I don't need to worry about the Robin Hood crowd and all the money flowing into Bitcoin or Tesla or whatever it is, because I know that 80% of the monies to be invested out there are held by people like me, aging baby boomers. We control 55 and older, control 80% of the money out there, and we are nervous Nellies. That's what this chart shows, that even as interest rates have come down, money's going into bond mutual funds and ETFs continue on very, very strong. Not until the big money starts to move towards stocks, I think, do we have anything to worry about. And now we can use Trump with a small t, because a record $10 trillion on the sidelines of dry powder will trump, in my view, whatever it is that you may be worried about. This is excess in personal savings, money supply, the Fed's balance sheet above normal. This is before the next stimulus checks. The market will love that in the near term. What about the longer term? And as I complete my comments to you before I turn it over for question and answer, I'm a baby boomer. We were the largest generation ever until the millennials came along. The millennials and the Gen Zs behind them, they are by far now the largest generation ever. I am so pleased to give up center stage to them, for they are the most technologically savvy, the most well-educated of any generation that we have ever had. The millennial generation in particular, I'm sorry, this chart was a 2017 chart. I need to add 3 years. Your average millennial is 30 years old today. What a great age, 30 years old. That is the beginning of their peak prime income years, and that doesn't peak out to 2038. All else equal, you want a growing population, and you want a growing population of productive people. And that is what this chart shows. The prime skilled adults are surging. Here we were up until this time, we saw a lot of boomers retiring, but the millennials, they were still too young to be in their prime productivity years. And guess what? That's turning around. This is great news for the United States of America. I'm happy to be a USA investor. And just one last chart, something to chew on. Something to chew on. By 2030, there will be more millennials and Gen Zs than older generation voters. I thank you very, very much for the chance to talk to the group today. And I will now turn it back to Ann and see if there are any questions or comments from the group. Thank you all so very much.
Thank you, Linda. Wow, you really jam-packed a lot of information. We appreciate your expertise, your analysis, and your vision for the future. It's pretty exciting to hear that herd immunity you feel will be achieved by June, and that you and your colleagues are predicting July 4th, a world opening. I mean, it's really only 5 months away, so we'll get our plane tickets and look for that pent-up demand hitting our economy. So we do have several questions for you, Linda. The first one is, you covered governmental debt. How would you view corporate and consumer debt with respect to the risks of rising interest rates?
Well, thank you very much for the question. It's very interesting in so far as after the global financial crisis, people were shell-shocked and businesses were shell-shocked. It ended way back in 2009. And we had a very slow but steady growth in our economy since that time. And corporate earnings continued to move up, and the market continued to move up, and people were still very, very cautious, very, very concerned, to where you saw both businesses and consumers really cleaning up their balance sheet. And if a business particularly went out there and borrowed new money, for the most part, it was to pay off older debt that had a higher coupon. It was actually to improve their own balance sheet. You saw that for a very, very long time. It was only really after the big tax cut in 2018 that fueled really the beginning of a decent move for consumers in terms of housing, and housing is enjoying quite a boom right now. There aren't enough homes for the expected number of houses needed, and lumber is in very short supply, et cetera. So you're only beginning to see the increase in borrowing by the consumer. So basically, as we embark on this particular growth, you know, I did used to show that in terms of the both the consumer and businesses in terms of their free cash flow, but it's just been slowly growing for both of them to really record highs. There's nothing to worry about in the foreseeable future that way.
Thank you, Linda.
Thank you.
You mentioned Bitcoin earlier. In relation to the value of the dollar, how much do you see Bitcoin and the like as a threat to the American dollar?
Well, one of the main things that Bitcoin and cryptocurrencies in general are meant to do are to allow an even playing field, so that you don't have to pay for things in your own currency. So you don't get punished if you're in a country that has a weak currency. And this is clearly a move towards the future. It is a problem for the United States to be a reserve currency. It takes a very long time for any currency to become a reserve currency, a very, very long time. And we have known before Bitcoin ever came to the fore that Asia is working to become the next major reserve currency. And that definitely is something that's probably on the horizon before a Bitcoin would do so. You know, it's been breathtaking how quickly have technological advances occurred. I'm always saying that. I'm always surprised. But Bitcoin and cryptocurrencies are early on in their moves, and the argument against a Bitcoin to really get in the way of the United States currency or any other global currency is, number one, it gets to be too big. It may very well suffer a re-regulation. It's as we all know, it's getting institutional investors. It's starting to really get some big names behind it. But in terms of using it as a source of monies to buy and sell things, it still has a long way to go. We need to whittle down that group, and this might bring regulation along the way. And importantly, secondly, central banks along the way may not just go away and let Bitcoin take away their power at all. There is much discussion already going on that central banks around the world are potentially beginning to work on they call it a digital currency, so that they would have the ability to manage that crossover. So I wouldn't worry about the dollar for that reason. The much more immediate concern is just spending and spending and spending away.
Thanks, Linda. We have many of our members that are involved in education, from the university level to superintendent of school districts to private education to early child care centers. What should those of us that are in the education industry be training our students for? Is it machine operating is machine operating a major focus, or should we still be training for the skilled trades?
That's a really cool question, because as we stand right now, there aren't enough craftsmen out there, and that's been a problem that's clogged the university system. It's got the price of going to university too expensive. And it's given us many people taking majors that are then they're not usable to get a job afterward or to have a trajectory. There are many studies out there that are looking for what could I tell my children or the children that I'm teaching that they should, what areas should I tell them to pursue that will not be affected by machines. Artificial intelligence and machines are changing the landscape of virtually every sector in the economy today, every single one. And when you think about machines and operating machines, for example, just have to look at some of these 3D printing outfits. It's so fascinating to read about 3D printing, where a house is being made, I think it's over in Japan, on a 3D printer, quicker than the best mason in the world could make that house. So you can't compete with this. So what you in the teaching profession, which is, it's never been appreciated as much as it should be, how we mold our children thanks to teachers. And and much like law enforcement, I fail to understand how they don't make much more money for how important they are. But these sort of areas that can't be taken over by a machine are very much worthy of pursuing. As we learn, and of course, the technology background, the ability to go work at these technology companies, because as much as we can't believe what we can do today thanks to technology, our grandchildren are going to think that was quaint, someday. It's just a crazy and great time to be alive in that way.
Thanks a lot, Linda. We really appreciate your expertise and your vision and your messages. And yes, I think we all have a much greater appreciation for educators, those of us with children and those of us that have employees with small children now at home and trying to balance both. So thank you so much for your insights. We appreciate you joining us today. And hopefully when you come back, since your prediction is as of July, we'll be back to in-person meetings. You can join us and we can have you enjoy a nice lunch with our members as well. But thanks to our members for all those great questions. And Linda, we do have a book in your honor that will be donated to the York YMCA library for their childcare. And that is An Elephant and Piggy Biggie by Mo Willems. And we'll send a book plate to you for your signature that will be placed in the front of that book. So thank you for joining us.
Thank you. Thank you so much.
And members, I want to let you know that next week, our club meeting will feature a virtual program on the COVID-19 vaccine, big part of Linda's prediction for July 4th. And that is by Darren Schultz. He is the Vice President and Director of Community Pharmacy by Minnick Pharmacy. So please join us next week. And just a reminder that you can join us at 11:30, and that's a great way to connect with fellow Rotarians and share some insights and some greetings. It really is nice to connect, and Linda joined us early as well. Our closing song is Aretha Franklin, Respect. And I don't know if Doug Berman had on a red tie today, but we're just going to go with a Valentine's joke for Doug and all of you. What kind of flowers shouldn't you gift your girlfriend on Valentine's Day? Cauliflowers. So Doug, don't get Mrs. Berman cauliflowers. Hope you all have a great week, everyone. Enjoy Aretha Franklin. Happy Valentine's Day. Take care.